All right, let's pull back the curtain and look under the hood of one of the most powerful and, yeah, often misunderstood machines in the entire global economy, the investment bank. When you hear the word bank, you're probably thinking about your local branch, right? Savings accounts, maybe a car loan or a mortgage. But we're about to step into a completely different universe, a world of high finance that operates on a scale that's, well, it's just massive. Okay, so here's the big difference right here. A retail bank, that's for people like you and me. An investment bank, they serve massive entities. We're talking huge corporations, entire governments, and major institutions. They're not handling savings accounts. They're dealing in capital and high-level strategic advice. They are quite literally the engine for the markets themselves. So, what really drives this financial engine? Well, it pretty much comes down to two core functions, and they are very, very different from each other. Think of them as the two main pistons just powering everything. You've got the advisors and you've got the traders. So, this first piston is the advisory side. This is where bankers help companies raise just enormous amounts of money. The process is called underwriting. Basically, they're the ultimate financial matchmakers, connecting companies that desperately need capital with the investors who are looking to put their money to work. And you see this perfectly in an initial public offering, an IPO. This is that huge moment when a private company decides to go public. The investment bank is their guide through this whole crazy process. They do intense due diligence, combing through every single financial detail. Then they structure the deal, figure out the perfect price for the shares, and finally, boom, launch them onto the open market. And it's not just IPOs. These bankers are the strategic architects behind those massive corporate mergers and acquisitions you read about in the news. They're the ones figuring out what a company is worth and putting the whole deal together. This is the long game, the relationship-driven side of the bank. Now for that second piston. This one moves at lightning speed. We're talking about the trading division. Here, they're what's known as market makers. What does that mean? It means they are always, and I mean always, ready to buy or sell. They make sure that if you want to trade something, there's always someone on the other side of that transaction. This is what we call providing liquidity, and it's what keeps the gears of the market turning smoothly. The name of the game here is speed, pure, unadulterated speed. In modern trading, every single millisecond counts, so these trading systems are built for what's called ultra-low latency. That means the delay in processing data is so tiny, it's practically non-existent. And this incredible speed advantage, well, that's the secret sauce behind high-frequency trading, or HFT. Just try to imagine these powerful computer algorithms executing millions of orders in the blink of an eye, all just to profit from tiny, tiny little changes in price. It's mind-boggling. So what exactly fuels this high-speed, high-stakes engine? It's not just money. Oh no, it's math and data on a truly colossal scale. I mean, think about it. When you're dealing with this kind of speed and this volume of trading, managing the unbelievable financial risk is a monumental challenge. So how on earth do they do it? The answer is incredibly complex mathematical models. And we're not talking about your basic spreadsheets here. We're talking about things like the Black-Scholes model, which helps figure out the fair price for a financial option, and these advanced Monte Carlo simulations that run thousands of what-if scenarios to try and predict what the market might do next. And here's a little peek at how they actually try to quantify that risk. For something like credit risk, they calculate variables like the probability of default, that's the chance a borrower just won't pay them back, and the loss given default, which is exactly how much money the bank would lose if that happens. It's all about trying to turn uncertainty into a number you can work with. And to make these models work, to make them accurate, they are fed with an almost unimaginable amount of data. We're talking about petabytes. That's thousands of terabytes of historical market data and old transaction records. It's just a staggering amount of information. So to process all of this data in real time, you need some serious computing power. Investment banks run these huge grid computing farms. They're essentially linking hundreds, sometimes thousands of servers together, all running high-performance code. It basically turns the bank into a cutting-edge technology operation. Okay, so we've got these powerful advisory and trading pistons, and they're fueled by all this data. So what does this financial engine actually produce? What's its real impact on the rest of the economy? Well, it plays two absolutely critical roles. First is capital allocation. They get money from investors into the hands of companies that need it to innovate, to expand, and to grow. And second is market liquidity. By always being there to trade, they provide the stability and efficiency that our financial markets really depend on to function day to day.
But of course, an engine this powerful, it needs some really robust safety systems. Because without them, things can go very, very wrong. So let's take a look at the guardrails that are designed to keep this whole thing on track.
After the 2008 financial crisis, regulators stepped in and put a whole new set of rules in place to try and stop banks from taking on way too much risk. One of the biggest was something called the Volcker Rule, and it was designed to build a wall, separating a bank's own risky trading from the activities it does for its clients. So, the rule basically says banks can't make speculative bets with their own money. That's called proprietary trading, but they can still trade on behalf of their clients. And as you can imagine, making that separation requires some seriously sophisticated IT systems to track and classify the purpose behind every single transaction. And with the explosion of high-frequency trading, regulators now demand a complete, unchangeable audit trail with millisecond precision. I mean, every single step of a trade has to be logged, all to make sure the markets stay fair and to prevent any kind of manipulation. Which brings us to this really crucial realization, and this quote just nails it. An investment bank is a technology company with a banking license. In the 21st century, you just can't separate the two. Their competitive edge relies just as much on their tech as it does on their financial smarts. They're totally intertwined. And that's the final thought I want to leave you with. As finance just keeps getting faster and more automated, and as technology and banking continue to merge into one, where does the true power of this engine really lie now? Is it in the financial wizards, or is it in the code they write?